On January 15, 2026, Bank of America CEO Brian Moynihan warned that $6 trillion could exit the traditional banking system. That's not a market correction. That's 30% of all commercial bank deposits in the United States. Most people believe their bank account is the safest place to store cash. The FDIC insures it, the government backs it. Your money sits there, protected. But the data shows something different. Commercial bank deposits sat at $18.6 trillion in January 2026, and they've begun declining at an accelerating rate. The money isn't disappearing. It's migrating to yield-bearing digital alternatives that didn't exist as regulated instruments until 18 months ago. Today, I'm walking you through the three-stage extraction mechanism: the regulatory kill switch that legalized the exodus, the proof of concept that tested the infrastructure, and the maturity wall where traditional banking becomes mathematically obsolete. A mandatory protocol before we open the file: this is not financial advice. I am not a licensed advisor. The math follows a script, but your capital is your responsibility. Always conduct your own research. The kill switch has a name: the Guaranteeing Essential National Infrastructure in U.S. Stablecoins Act, Genius Act, signed into law in July 2025. You see, before this law, stablecoins existed in a legal gray zone. They were crypto assets, unregulated, high risk. The average person wouldn't touch them, and institutions couldn't hold them on balance sheets without triggering compliance nightmares. The Genius Act changed that overnight. It created the first federal framework for payment stablecoins, transforming them from speculative tokens into regulated deposit substitutes. Which means stablecoins can now be backed one-to-one by U.S. Treasury bills, which means they can offer the same yield as short-term government debt, 4 to 5%, while your traditional bank savings account offers near zero. The stablecoin market cap reached $315 billion by January 2026. But that number is a distraction. The exodus Moynihan referenced isn't about the current stablecoin market. It's about the mobile 30 to 35% of the $18 trillion deposit pool that is now sensitive to yield differentials. That's the $6 trillion at risk. You're watching a liquidity migration in real time. The law didn't just legitimize stablecoins, it weaponized them. Plus, the Genius Act included a critical provision. Stablecoins under this framework must maintain one-to-one reserves in low-risk assets like treasury bills, no fractional reserve lending, no rehypothecation, no bank runs. Traditional banks keep roughly 10% of deposits in reserve and lend out the rest. If 30% of depositors demand their cash simultaneously, the system collapses. Stablecoins don't have that vulnerability. They hold 100% reserves, which means depositors now have a choice. Park your money in a bank that pays you nothing and uses your capital to generate profit for shareholders, or migrate to a regulated digital instrument that pays you treasury yields and can't gamble with your principal. The script writes itself. Banks are already lobbying Congress to ban yield on stablecoins. They're calling it unfair competition. But the regulatory window is closed. The Genius Act is law. The infrastructure is live. You see, Moynihan didn't issue that warning because he's worried about the future. He issued it because the migration has already started. Circle, the issuer of USDC, is preparing for an IPO in March 2026. Fidelity is launching its own stablecoin. These aren't speculative startups. These are institutions with trillions in assets under management, positioning themselves as the next generation of deposit-taking entities. The banks missed the window. The law passed while they were focused on lobbying against crypto. Now they're watching the very regulation they ignored create a parallel financial system that is mathematically superior to the one they control. If this regulatory mechanism just clicked for you, or you want to track these monetary shifts as they happen in real time, join the Forensic Circle by hitting subscribe. The next phase involves a $70 billion proof of concept that most people think is about Bitcoin, but the math tells a different story. But even this $6 trillion exodus is a distraction from the real extraction already underway. Because while everyone was watching stablecoins, the largest asset manager on earth quietly built the infrastructure to tokenize the entire treasury market. And they used Bitcoin as the test case to see if the pipes could handle the volume. BlackRock's iShares Bitcoin Trust launched in January 2024. Within 341 trading days, it hit $70 billion in assets under management. That made it the fastest growing ETF in history, 5 times faster than the previous record holder, SPDR Gold Shares, which took nearly 2,000 days to reach the same milestone. Wall Street called it a Bitcoin revolution. The media celebrated it as mainstream adoption. Retail investors piled in, thinking they were getting early access to digital gold, but the math tells a different story. You see, IBIT wasn't designed to be a Bitcoin fund. It was designed to be a stress test. BlackRock needed to know if the traditional financial rails could handle the velocity and volume of tokenized asset migration. They needed to see if custodians, broker-dealers, and settlement systems could process billions of dollars moving into a blockchain-native instrument without breaking. IBIT proved they could. $70 billion flowed into a single product in less than a year. No liquidity crisis, no operational failure. The pipes held, which means the infrastructure was ready for the real extraction. In March 2024, while IBIT was dominating headlines, BlackRock launched something far more dangerous to the traditional banking system: the BlackRock USD Institutional Digital Liquidity Fund. Ticker BUEDL. It's a tokenized money market fund built on Ethereum. By late 2025, it reached over $2 billion in assets, making it the largest tokenized money market fund globally. Most people ignored it. $2 billion sounds insignificant compared to IBIT's $70 billion. But BUEDL isn't competing with IBIT. It's competing with your bank account. Here's the mechanism. A traditional money market fund allows you to park cash in short-term government debt and earn yield. But accessing that yield requires going through a financial intermediary, a brokerage, a fund manager, layers of friction, layers of fees. BUEDL eliminates the intermediaries. It's a tokenized fund, which means ownership is represented by blockchain tokens that settle instantly, 24/7, 365 days a year. You don't need a brokerage account. You don't need to wait for market hours. You hold the token, you own the yield. Plus, because it's built on Ethereum, it's composable, which means your tokenized treasury position can be used as collateral in decentralized finance protocols, lent out for additional yield, or transferred globally in seconds. Your bank savings account can't do any of that. But here's where the black magic starts. BlackRock didn't choose Ethereum randomly. As of January 2026, Ethereum hosts approximately 65% of the tokenized real-world asset market. It's the dominant infrastructure layer for on-chain finance, which means every transaction, every settlement, every yield distribution that happens on BUEDL runs through Ethereum's network. You see, when BlackRock tokenizes a treasury bill and puts it on Ethereum, they're not just creating a new financial product. They're migrating the ownership layer of U.S. government debt onto a decentralized ledger that operates outside traditional banking infrastructure. Think about what that means for your deposit. Right now, when you deposit money in a bank, the bank records that deposit in its internal ledger. You trust the bank to honor that ledger. If the bank fails, you trust the FDIC to make you whole up to $250,000. But when you hold a tokenized treasury position on Ethereum, the ledger isn't controlled by a bank. It's controlled by a decentralized network of validators. Your ownership is cryptographically secured. You don't need to trust an institution. You verify the position yourself. That's not an incremental improvement. That's a structural replacement. Plus, Ethereum's infrastructure allows for atomic settlement, which means when you transfer a tokenized treasury position, the ownership change and the payment happen simultaneously in the same transaction. No settlement risk, no counterparty exposure, no 3-day waiting period for funds to clear. Traditional banking settlement systems were built in the 1970s. They close at 5 p.m. They don't operate on weekends. They require multiple intermediaries to reconcile ledgers. Ethereum operates continuously. It never closes. It settles in 12 seconds. Which means the cost of holding your wealth in a traditional bank account just became a voluntary tax on inefficiency. Here's the extraction formula. Under the Genius Act, stablecoins can be backed 1-to-1 by U.S. Treasury bills. As of January 2026, short-term Treasury bills offer yields between 4 and 5%. Your traditional bank savings account offers near 0%. That's a 4 to 5% annual penalty for keeping your money in a bank. On a $10,000 deposit, that's $400 to $500 per year you're giving up. On a $100,000 deposit, that's $4,000 to $5,000. Multiply that across the $18.6 trillion in U.S. commercial bank deposits. And you're looking at $744 billion to $930 billion in annual yield that depositors are currently forfeiting by staying in traditional banks. You see, the moment depositors realize they can move their cash into a regulated stablecoin or tokenized money market fund and earn treasury yields without additional risk, the migration becomes inevitable. It's not about trust. It's not about speculation. It's pure math. Plus, the BUEDL fund removes the last barrier, institutional access. Tokenized funds were previously limited to accredited investors, minimum investments of $100,000 or more, regulatory complexity, operational friction. But as the infrastructure matures and regulatory frameworks like the Genius Act standardize access, the minimum thresholds drop. Circle is already offering USDC with no minimum investment. Fidelity's stablecoin will likely follow the same model, which means the yield arbitrage that was once available only to institutions is now available to anyone with a smartphone. The banks don't have a countermove. They can't raise deposit rates to 4 or 5% without destroying their net interest margins. The entire banking model depends on borrowing your deposits at 0% and lending them out at 5 to 7%. If they have to pay you 4% for your deposits, the math collapses, which means they're locked into a losing position. They either accept the deposit exodus or they lobby Congress to ban yield on stablecoins and tokenized funds. They're already trying the second option. But the Genius Act is law. The Ethereum infrastructure is live. BlackRock has $2 billion in Boydell and $70 billion in IBIT, proving the model works. The regulatory window has closed. Moynihan's $6 trillion warning wasn't speculation. It was a mathematical projection. If 30% of the $18.6 trillion deposit base is mobile and yield sensitive, and if those depositors can now access Treasury yields through regulated stablecoins and tokenized funds with zero friction, the exodus is inevitable. $6 trillion. That's more than the entire GDP of Japan. That's more than the combined market cap of Apple, Microsoft, and Google. And it's already in motion. Circle's market cap for USDC grew from $24 billion in early 2024 to over $60 billion by January 2026. Tether's USDT sits at $135 billion. Combined, the top stablecoins represent nearly $200 billion in deposits that have already exited the traditional banking system. But that's just the first wave. The Genius Act formalized the regulatory framework in July 2025. Boydell launched in March 2024. The infrastructure is 18 months old. You see, the early adopters were crypto-native users and institutions already comfortable with blockchain technology. But the next wave is everyone else. The retirees with savings accounts earning 0%. The small business owners holding operating capital in checking accounts. The ordinary depositors who just learned they can earn 4 to 5% risk-free by moving to a regulated stablecoin. When that cohort moves, the $6 trillion becomes $12 trillion. And the traditional banking system doesn't survive that. But here's the part that should terrify every bank executive on earth. This exact script has already played out once before. In the 1970s and 80s, a different financial innovation bypassed the banks by offering depositors direct access to Treasury yields, and it triggered a crisis that nearly collapsed the entire system. The banks couldn't stop it then, and the legal trap they're in now makes it mathematically impossible to stop it this time. Brian Moynihan didn't pull the $6 trillion projection out of thin air. He referenced it explicitly. The rise of money market mutual funds in the 1970s, same mechanism, same threat, same exodus. You see, before 1970, if you wanted to earn interest on your cash, you had two options. Put it in a bank savings account with a federally capped interest rate, or buy Treasury bills directly, which required a minimum investment of $10,000. Most people couldn't access Treasury yields. The banks had a captive deposit base. Then came Regulation Q. It was a Depression-era rule that capped the interest rates banks could pay on deposits. The goal was to prevent banks from competing for deposits by offering unsustainably high rates. But by the 1970s, inflation was running at double digits, and Regulation Q capped savings account rates at 5.25%. Treasury bills were yielding 15%, which means depositors were losing 10% per year in real purchasing power by keeping their money in banks. The money market mutual fund was the exploit. It allowed ordinary investors to pool their money and buy Treasury bills collectively, bypassing the $10,000 minimum. They could earn the full Treasury yield, no bank intermediary, no interest rate cap. The first money market fund launched in 1971 with $10,000 in assets. By 1982, money market funds held over $200 billion, nearly 20% of total bank deposits at the time. The banks lost the deposit war in 11 years. Plus, the exodus triggered a liquidity crisis. Banks depend on deposits to fund loans. When deposits flee, lending contracts, credit freezes, the economy stalls. The Federal Reserve had to step in and deregulate interest rate caps in 1980 to let banks compete. But by then, the damage was done. The money market fund industry had established itself as a parallel deposit-taking system. The banks never fully recovered that market share. The script is identical. In the 1970s, Regulation Q created an artificial yield gap between bank deposits and Treasury bills. Money market funds exploited that gap. In 2026, fractional reserve banking creates an artificial yield gap between bank deposits and Treasury-backed stablecoins. The Genius Act legalized the exploit. The math is even worse for banks this time. Money market funds in the 70s required investors to write checks, mail applications, and wait for settlement. Friction kept the migration slow. Stablecoins settle in seconds. You can move your entire deposit base from a bank to a Treasury-backed stablecoin in the time it takes to confirm a transaction on Ethereum, which means the exodus velocity is exponentially faster. Plus, the infrastructure is global. Money market funds were US only. Stablecoins operate 24/7 across every jurisdiction with internet access. A depositor in Europe, Asia, or Latin America can hold USD-denominated Treasury yields without ever touching a US bank. The deposit base isn't just mobile, it's borderless. You see, Moynihan's warning wasn't about innovation, it was about inevitability. The same cycle that drained 20% of bank deposits in the 80s is now playing out with digital infrastructure that moves at the speed of light. The banks know this. That's why they're lobbying to ban yield on stablecoins. But the legal trap has already been set. In 2008, when banks failed, taxpayers bailed them out. Lehman Brothers collapsed, Bear Stearns collapsed, AIG collapsed. The government stepped in with $700 billion in emergency funding to prevent a total systemic meltdown. The public outcry was immediate. No more bailouts. So in 2010, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act. Title II of that law is called the Orderly Liquidation Authority. It's the kill switch for banks. Here's the mechanism. If a bank fails due to liquidity flight, Title II ensures that shareholders and creditors, not taxpayers, bear the losses. The FDIC steps in, seizes the bank, and liquidates it in an orderly process. Depositors are protected up to $250,000. But bondholders, shareholders, and large corporate depositors take the hit, which means if the $6 trillion exodus triggers a wave of bank failures, the government will not bail out the banks. It will let them collapse. Plus, Title II includes a provision for bail-ins. A bail-in is when a failing bank converts your deposits into equity to recapitalize itself. Your cash becomes shares in a collapsing institution. It's legal. It's codified. And it's already happened in Cyprus in 2013, where depositors lost up to 47.5% of their balances overnight. You don't own your deposit. You're an unsecured creditor to the bank. The moment you deposit money, it becomes the bank's liability. You're owed that money, but the bank owns it. And if the bank fails, Title II determines the order of claims. Secured creditors get paid first, then unsecured creditors, then depositors above the FDIC limit. If you have $300,000 in a single account and the bank collapses, you're getting $250,000 from the FDIC. And the remaining $50,000 is subject to the liquidation process. You might get 30 cents on the dollar. You might get zero, which means large depositors. Small businesses with operating capital, retirees with rollover IRAs, corporations holding payroll reserves are now staring at an existential risk that didn't exist before the Genius Act. They can stay in a bank and risk a bail-in, or they can migrate to a Treasury-backed stablecoin with one-to-one reserves and zero counterparty risk. The decision is mathematical. Traditional banks operate on fractional reserve lending. They keep roughly 10% of deposits in reserve and lend out the other 90%. That's how they generate profit. They borrow your money at 0% and lend it out at 5 to 7%. The spread is their margin. But fractional reserves create systemic fragility. If 30% of depositors demand their cash simultaneously, the bank doesn't have it. The FDIC steps in, but the process takes time. Your funds are frozen. Your liquidity is gone. Stablecoins under the Genius Act operate on full reserves. 100% of stablecoin issuance is backed by treasury bills or cash equivalents. No lending, no leverage, no fractional gains. Which means a run on a stablecoin is mathematically impossible. Every token can be redeemed for $1 immediately. No waiting period. No liquidity freeze. You see, the banks are structurally disadvantaged. Their entire business model depends on borrowing your deposits at zero and lending them out at a spread. If they're forced to compete with stablecoins offering 4 to 5% yields, they have to raise deposit rates, which destroys their net interest margin. They can't win on yield. They can't win on operational resilience. They can't win on settlement speed. The only advantage they have left is inertia. Most people haven't heard of BUIDL. Most people don't understand how to hold a stablecoin. Most people trust the system they grew up with. But inertia is a decaying asset. January 2026 is the convergence point. The Genius Act became law in July 2025. That gave the market 6 months to build the infrastructure, establish custody solutions, and onboard institutional players. By January 2026, the pipes are live. Circle is preparing its IPO in March. Fidelity is launching its stablecoin. BlackRock has $2 billion in BUIDL, proving the institutional demand is real. Plus, the macro conditions are accelerating the timeline. The U.S. is carrying $36 trillion in federal debt. Interest payments on that debt exceeded $1.1 trillion in 2025, more than the entire defense budget. The Treasury has to keep issuing new debt to pay interest on old debt, which means Treasury bill supply is increasing, which means yields remain elevated, which means the arbitrage between bank deposits and stablecoin yields stays wide. You see, the banks are hoping the Federal Reserve cuts rates and compresses Treasury yields back to zero. If short-term Treasuries yield 0%, stablecoins lose their competitive advantage. But the math doesn't support that scenario. With inflation still running above 3% and federal debt service costs ballooning, the Fed can't afford to cut rates to zero without triggering a currency crisis. The yield arbitrage is structural. It's not going away, which means the $6 trillion exodus isn't a possibility. It's a countdown. The banks know they can't stop this. The regulators know the legal framework has already legitimized it. And the institutions building this infrastructure know the migration is inevitable. The only question left is whether you position yourself in the system that's collapsing or the one that's replacing it, Most people will ignore this data and keep their deposits exactly where they are. They'll trust the system. They'll assume the banks are too big to fail. They'll wait for the headlines to tell them it's happening, by which point the exodus will already be complete. But if you're the type of person who refuses to be a victim of the script, subscribe. We hold ourselves to a different standard here. We read the fine print, we track the legal frameworks, we watch the institutional positioning before the public narrative catches up. The next forensic breakdown covers the specific infrastructure providers positioning themselves as the picks and shovels of this migration, the custody solutions, the settlement layers, and the tokenization platforms that will capture the toll revenue as $6 trillion moves through their pipes. Make sure you're subscribed so you don't miss it. The $6 trillion exodus isn't a theory. It's a migration to the next generation of financial infrastructure. The banks are already lobbying Congress to ban yield on stablecoins. They're calling it an unfair competition. But the Genius Act is law. The infrastructure is live. The timeline is set. Circle's IPO launches in March 2026. Fidelity's stablecoin follows shortly after. The institutional framework is already complete. Q1 2026 is the inflection point. You see, the script has been written 3 times before. Money market funds in the 70s, online banking in the 90s, mobile payments in the 2000s. Every time, the innovation bypassed the banks. Every time, the banks lobbied to stop it. Every time, they failed. The difference this time is the velocity. Stablecoins settle in seconds. The infrastructure is global. The yield arbitrage is structural. The math is no longer sustainable. Your move.